Hi guys, very good morning. So yeah, just because of some technical issues, we had to uh, delay the live. So yeah, we will start with the pre-market. So yeah, I'll share the screen now. Yeah, hope you guys can see the screen now. Yeah, we'll start with the pre-market. Whatever happened the overnight and what happened in post-market. Yeah, GIFT Nifty signals positive open. The GIFT Nifty futures were quite at 24,148 up to 90 points, signaling a positive open for Nifty 50 and Sensex today. The global cues, most Asian markets are advanced with Nikkei 225 up to 2.05 percent and Kospi up to 1.07 percent, ignoring the US President Donald Trump's latest threats of striking Iran despite the peace agreement. So global indices as this morning, Nasdaq is 26,517 with 1.97% of increase, and Dow Jones 51,564 with 0.14% of high, and S&P with 500 with 7,500 plus 1.09%. Yeah, some key intraday levels for the day are for Nifty, the primary resistance zone is 24,000 to 24,051. Assistance close about 24,051. On a 15 minutes basis, open upside towards 24,136 to 24,200. On the downside, reach of 24,000 risk as a slide to 23,900 and deeper to 23,818. Yeah, the big stocks we should focus today are Reliance. It's Chairman Mukesh Ambani highlighted record FY26 results. It's worth 11.76 trillion, massive capex of 1.44 trillion in FY26, and expressed strong confidence in more than doubling consolidated EBITDA in the next coming 5 years. And these are the some key highlights. So Geo IPO milestone, aggressive push into AI and satellite, retail and FMCG, and green energy transmission. And market bias for the day are short-term bias are constructive to mildly bullish, but only if Nifty holds about 24,051, as I mentioned before, on a sustained basis. Otherwise, expert range bound chop around 24,000, and the weekly chart shows doji candlestick pattern, like indicating indecisiveness between bulls and bears. Yeah, we'll talk about the geopolitical. WTI crude fell because $80 per barrel. Like after Israel and Israel agreed to a ceasefire, heading for a weekly loss of -8%. The truce, if sustained, could support wider US-Iran peace efforts and ease supply fears. Positive for India's important bill. Yeah, Geo IPO filed. This is an important story for today. It's the biggest story. The digital art of Reliance and Industries has filed a draft red heading with SEBI to raise funds through an IPO. The IPO compromise an entirely fresh issues of 27 crore equity. It proceeds with the use for repaying of debt amounting of 27,500 crore and generated corporate purposes. And as I mentioned, Mukesh Ambani confirmed the record FY26 gross revenue of 11.76 trillion, capex of 1.44 trillion in FY26. It expressed confidence in more than doubling, consolidating EBITDA over the next coming 5 years. As I mentioned, it's my second time mentioning this. So, is this because you should keep in mind about this particular stock? And for the investors in Reliance Industries, the Geo IPO could be a key for unlocking value and delivering the balance sheet through the final valuation and market timing remain crucial variables. Yeah, Rail Vikas Nigam has received a letter of award worth 2,977 crore from NMDC for the setting up buffer stockpiles and blending yard with a handling capacity of 10 MTPA and Vizag, Andhra Pradesh. This is a significant infrastructure order. RVNL has been an order with the street, and this adds to order book. And you should watch for a gap up opening in RVNL today. There is a good gap up opening today. Volume set open will be the key trigger to watch for today. And strong volume plus price sustaining above previous close. It's a bullish continuation for today. Yeah, we'll talk about the Bharat Forge with the 426 crore Navy defense contract. It has landed for 25 crore defense contract with the Ministry of Defense to supply gas turbine. Yeah, since one of our viewer is asking about PI and the long term position. Yeah, for the particular stocks, our expert will answer all these viewers' question now.
Hi guys. So one of the viewers asked about a particular stock. We'll just uh, we'll just look at this particular stock. The viewer has asked about TA Industry Limited. So we'll look at the higher time frames first to get a view on the stock. Yeah. So the stock has recently shifting. If we look at this time frame, 15 minutes time frame, we could see that the stock has returned to the demand zone. So given as a structure break over here, and it has also uh, it is currently trading near a trend line. So just wait for the close above the trend line. So once the price closes above the trend line, you can wait for the yeah you can just wait for the indicator to give us a so if we see before the indicator has given a sell signal and we would have gained around 2% if we would have short the position. So just wait for the price to close above this level so that we could get a confirmation that the price is moving in a uptrend. So the price has recently broken as it has given a structure shift. So we can wait for a retracement. We can wait for the break, and if we look at the smaller time frames, yeah, in a smaller in 5 minutes time frame, we could see that there is a close above this resistance level. And it has also created a demand zone here. So we could see the candles creating imbalances. So these are a strong sign for a bullish momentum. So we can see aggressive buyers are entering. So just wait for the candlestick pattern near any retest zones. Don't blindly enter. Just you can look for a retest or a candlestick pattern rejections, so that we can confirm with those candlestick patterns. So hope the long term view on this particular stock is clear for the viewer. Let me know if you have any doubts. Thanks. So let me know if you have any doubt on this PI Industry Limited stock. So since the market has recently shifted its structure, we can wait for the uh, particular confirmation near zones or a support resistance level which is recently broken. So Sushma will be continuing with the news. So put out your favorite stock in the comments. Yeah, she'll be continuing with the news. Let me know if you have any particular stock to be analyzed.
About Bharat Forge, it has landed a 425 crore defense contract, as I mentioned. And defense is already a hot sector, and Nifty India Defense Index has been outperforming currently, and it's outperforming consistently. It was the top gainer among the thematic indices recently, with up to 2.8% versus 0.3% rise in Nifty 50. These contracts add like solid revenue visibility for Bharat Forge defense arm. Investors should watch margins, since materials and supply chains costs in defense contracts can squeeze them. Yeah, the next one is Tata Motors. It has secured over 3,400 electric commercial vehicles across various segments, comprising 2,000 SUVs and pickups, 900 trucks, and 500 buses, marking a significant inflection point in mainstream EV adoption. This is a very positive signal for Tata Motors as a whole. Commercial EVs next big battleground in India. The focus for investors in daily retirements are whether Tata Motors can defend margins in the competitive EV space, and watch Tata Motors parent stock as derivatively played today. Yeah, the next is Nifty IT sector. This sector overhang every viewer trading IT must know. Index plugged more than 6% on June 19th, emerging as the worst performing sectorial index of the day. After global IT consulting gained, Accenture lowered its revenue growth guidance of FY27. The sharp correction triggered a board face sell-off across Infosys and HCL, TCS, also Tech Mahindra, LTM, Persistent Systems, Coforge. Leading the sell-off was Infosys down of 7.59% to 1,041.9, and TCS down of 5.46 with 2,082.9. And also Wipro went down with 3.38% of 176.66 rupees. Accenture got the top end of its annual revenue forecast by 100 basis points, revising to 3 to 4% from 3 to 5%. The key concern is that global enterprises, mostly in the US, maybe continue caution and discretionary technology spending, which remains a major driver for Indian IT services. Analytics believe and Indian IT companies currently lack significant near-term growth catalysts. Some distilleries and breweries said its application for the grant of an excise license for its Bhopal plant for FY 2026-27. It has been rejected by the excise departments of Madhya Pradesh. Exact a sharp negative reaction in this counter today. License rejection directly impacts production capacity and revenue for a liquid company. Avoid catching this falling knife for intraday. This is for intraday traders. And we'll take a quick technical summary. Nifty key levels. Buy on dip strategy valid 23,750 on a closing basis. A decisive close about 24,200 targets, 24,500 to 24,600. Below 23,750 could be a drag index of 23,600 to 23,500. And Bank Nifty supported 57,600 to 57,500. Holding above this maintains recovery structure. Sustains more about above 58,000. Needed for strong bullish momentum here. Yeah. This is all the pre-market, which the news which may happened all the night and in the 2 days when the market was not there. So yeah, if you have any particular stocks, or if you have taken any particular trade in particular stocks, let me know in the comments. We'll analyze for it. Yeah, now we'll talk about indexes, stocks and indexes now, and our exercise will take from now.
Sorry, guys. I think my voice wasn't audible. We had some issues here. So what I was explaining was about the explaining about the option chain. So if we look at the 24,100, we could see there is a increase in put OI. So so we always read this data from the option perspective of the option writer. Green bars means put writing, and which represent support flows, and red bars means call writing, which represent resistance ceilings. So diagonal strip indicate fresh money actively loading up today, and hollow boxes indicate panic unwinding and short covering. Yeah. So we could see that 24,100 has a higher green strike bars and than the call OI. So we could also see the difference. There is a put OI change of there's an increase of plus 1.85 crore, and call OI change as an increase of plus 1.01 crore. So we could see there's a massive difference between put OI and call OI. Call OI. So we can from this we can see that the buyers are aggressive. So the fact that put writers are aggressively loading up with fresh capital signaled by those heavy green diagonal strikes tells us that institutional desks are making a concentrated effort to convert 24,100 from an intraday hurdle into an active launch pad. So, however, the call writers aren't surrendering easily. We could see 1.1 crore increase in call Y. So, they are matching the volume blow for blow, but keeping the immediate premium pricing highly volatile. So this is your crucial pivot point for the morning session. And if we look at slightly higher up the ladder to locate the main institutional roof, so scan the right side of the chart. We can see 24,200 strike. Look at the massive dominant red striped block tower. So we could see there's a call OI increase of 83.26 lakhs and put OI increase of 56 lakhs. So this is our main resistance wall for this morning session. So the heavy accumulation of fresh trade contracts tells us that large market making desks have drawn a firm line in the sand at 24,200. So they are collecting thick premiums and betting millions that Nifty will not comfortably scale past this level ahead of tomorrow's expiry. So for your intraday setups, this means any random spike or momentum burst will face serious friction as it approaches towards 24,200. So do not buy out of the money calls blindly, expecting a massive non-stop runway rally while the massive red fall stands at that height. So unless the tower begins to actively lose its stripes, we could. I have already mentioned that if there is a hollow, it means there is a decrease in the call OI. So if you see a breakout above 24,200 and the call OI starts to decrease, then you have a strong. It is a strong signal indicating that the buyers are aggressive. So it still acts as a structural cap on index immediate upside. So let's look at the defense mechanism building on the lower end of the chart. We can see that 24,000 call OI has a massive increase. Put OI has a massive increase. And call OI, we can see there's a decrease of minus 16.16 lakhs. So that is an open interest decrease. It's a pure trader psychology caught on tape. The call writers who are aggressively shorting the market on Friday beneath 24,000 are now in absolute panic. So with the index gapping up to 24,018, they are being forced to cover their positions, unwinding their short as loss. We see that we saw that Friday was a correction. There was a market correction in Nifty since there was news related to Nifty IT industry. Market was in a correction phase. So the short covering acts as mechanical buying fuel, which is exactly why the 24,000 zone has officially solidified into an absolute ironclad concrete floor for this expiry cycle. So the downside risk is heavily insulated by the institutional retreat. So yeah, from this we can have two scenarios. So keep your eyes glued to the 24,100 battlefield. As long as Nifty holds about 24,100 and you see those green striped put bars expanding while the red bar call bars start to shrink. If you see the chart, if the price holds about 24,100 and you need to see the increase in the put to exchange, we could see here that it was around 1.81 cr and it has increased to 1.91 cr, and you need to look for the decrease in the call OI change, which was around 1.01 crore and it has decreased to 92.21 lakhs. So these are the indication that there is a strong aggressive buyers entering into the market, and the price is supporting the 24,100 zone. So the trap call writers at 24,150. If you see, there's a huge call OI build. There's a build up here, and even around 24,150. So these are will be these will be forced to cover their positions. So look for long triggers or minor pullback towards 24,100 and targeting a move towards 24,180 or 200 zone. So if we see, we could see the prices exactly come to 24,100. It has given us a market structure shift here, and it has closed above this resistance level, and it has again come back to the retest level here over here, and it is reaching towards 24,150. So 24,150 will still act as a resistance since there is a put OI build, call OI build up there. Yeah. So the second scenario would be what is bear mount and afternoon counter defense. If Nifty slips and prints 15 minutes candle close back below 24,100, so we saw that this support level is very strong. But if you see a red candle in a 15 minutes time frame closing below this level, then don't blindly go for short positions. Look at the open interest chart. You need to look at the call OI increase and put OI decrease. So once you see that change, then you might consider shorting the position. There are a lot of chances for Nifty to again go to yeah, it might go to 24,000 level support zone. So where you should aggressively look for stabilizing or long accumulation play. So these are the two scenarios for Nifty today. So it is strongly supporting a uptrend movement. If we look at the technicals, we could see there is a structure break, and if we look at the higher time frames, we can see that multiple charts showing green. Yeah. Multiple time frames showing agreeing with the bullish structure. So there's a less probability that the 15 minutes candle might close below the 24,100, and even though if it close, don't blindly go for short positions as the overall trend is bullish. Just look at the open interest chart. Look at the change in call OI. If it closes below 24,100, you need to focus on increase in call OI, and the put OI should decrease, so we could validate those price closing below 24,100. So these are the plans for Nifty today. Yeah. So I hope you got a clear picture on Nifty and option chain. So have an eye on it. I'll be back with Bank Nifty and its option chain. So stay tuned. So let me know if you have any doubts in Nifty. So put your plans in the comments. And let us know the plans you have for Nifty. So meanwhile, I'll just come back with Bank Nifty and its option analysis, option chain analysis. So yeah. So when we look at Bank Nifty, we could see that even there's a gap of opening here. So we'll just quickly jump into the option chain. So let's shift our gaze directly into a heavyweight mover of the Bank Nifty. So Bank Nifty index is flashing a constructive gain of 0.27%, comfortably hovering at 57,839. So if you glance up the top right, you could see the put call ratio. Yeah. So it is sitting dead center at 1. So this tells us that the intraday order flow is beautifully balanced. There's a high octane tug of war. The volatility index, India VIX is perfectly flat at 13, indicating the option writers are feeling incredibly stable, confident, and are aggressively collecting premium on both sides of the ledger. So let's decode the open interest change on for the 30th June expiry. So to see exactly where the large private or banking desks are locking down the range. So just a minute, guys. I'll be taking you through the option chain. Yeah. So we'll just so sorry, guys. Just a minute. Yeah. So we'll just focus on 57,800 strike. Yeah. If you see this, we can see this is the active epicenter of this morning session. So right at 57,800, we are seeing a fierce neck and accumulation. Yeah. So you can see the red bar is marginally higher with a dominant diagonal strike showing aggressive fresh call writing. So we can see there's a increase of 1.77 lakhs in call OI and put OI has an increase of 1.39 lakhs. So this tells us that sellers are trying to clamp down on a fast runway rally. But look right next to it, the green bar is charging hard with fresh strike put writing, providing the buyers are proactively stepping up to absorb the supply. So because Bank Nifty is trading at 57 or 851, the bulls are technically keeping their noses ahead of the pivot. So if we look at one step higher at 57 or 900, we could see there's another immediate red wall of call writing building up. The smart money is trying to slow the index down right here in this 100-point zone. We could see there's a call away change of 1.46 lakhs, but put away change as only increase of 87,750. So even though it's small in quantity, we could wait for the reaction. We could expect reaction in 57,900 zone. So the smart money is trying to slow the index down right here in this 100-point zone. So if you want to look at where the ultimate institutional no entry sign has been posted for the day, cast your eyes slightly right to the psychological 58,800. Yeah, yeah. 58,000. So look at the skyscraper, the 58,000 Paul OI tower is an absolute. It's an absolute. There's a lot of increase in Paul OI change. We see 3.92 lakhs has been increased and 1.22 lakhs is crypto increase. So it completely dominates the entire right side of the chart. So it signifies an aggressive, massive influx of fresh capital today. So we'll mark this zone in our technical chart as well. So if we look at the 58,000 level, it clusters with our resistance level over here, right? And we could also see a trend line passing here, which acts as a strong resistance zone. So just have a mark in your chart over this zone. Yeah. So institutional call writers are stacked deeply here. So they are heavily shorting the 58,000 call premium, making the strike the definitive ironclad resistance reading for the session. For intraday traders, any sharp momentum drive spikes towards 57,980 and 58,000 is highly likely to encounter a massive supply and profit booking unless a catastrophic short covering trigger occurs. So spotting the base and institutional foundations, just we'll look at the safety net and structural flaws. So if the bears try to trigger an intraday cooling off period, we'll just see where is the institutional support. So look at the 57 500 strike. So we can see a 57 500 strike here, right? So you can see a healthy, tall green bar of put. Interestingly, looking at the top of the adjacent 57,500 call bar, there is a subtle hollow box indicating a OI decrease, both in put and call. So we could see there's a 79,830 decrease in put OI and 60,290 in call OI. So this is the total amount as of 10:31. There is 7.51 lakhs and 5.76 lakhs in call OI. So call raters are quietly stepping back from 57,500, converting this into a robust immediate support zone. So and if things get volatile later in this week, look all way back at the 57,000 strike. This is a massive towering green pillar representing a rock solid bedrock support. Now, if you look at the 57, there's a less probability to pull this the price might touch this zone, but just have a look at it. So that's a massive towering green pillar representing the rock solid support. The institutional desk have essentially built a fortified fortress between 57,000 to 500 to ensure the structural uptrend remains fully insulated against minor global shocks. So, the scenarios for Bank Nifty would be we'll have two scenarios as usual. We'll see a range bound consolidation play. So with the PCR at a perfect neutral or indicating 1.1 and a massive red wall at 58,000 against solid green bases at 57,500. Bank Nifty is signaling a range bound afternoon session. So the index will likely consolidate between 57,650 to 57,950 because the optimal strategy here is playing reversals of the boundaries. So buying near 57,600 support, okay, and or selling near 57,900 resistance zone. So this would be the first scenario for the Bank Nifty, and second one would be the 58,000 short squeeze trigger. So if you are looking for a massive structural breakout, do not front run it. We must wait for Bank Nifty to sustainably trade above 57,900, and if it does, keep this chart open. The moment you see that monster 58,000 red bar to show a hollow box at the top, So if this call OI, if we see this, we see a decrease in this call OI, and if the price breaks above 58,000, meaning those massive call writers are beginning to panic and buy back their position. So that is your green light. So the short covering will act as an explosive rocket fuel, driving to a rapid 203-point short squeeze rally. So respect the 58,000 wall, monitor 57,800 fight between the call writers and put writers, and let the balance order flow dictate a disciplined risk management approach today. So this is the view on Bank Nifty and option chain analysis. So let me know if you have any doubts related to Bank Nifty and option chain. We'll just go to Sensex. Let me know if you have any doubts in Bank Nifty, and let me know your plan in the comments. So we'll look at the Sensex and its option chain analysis. I'll just change the chart. So yeah, if we look at Sensex, we can see the bulls are putting on an absolute on masterclass on Dalal Street. So it has surged past its morning hurdles, trading up a strong 0.59%, which is currently at 77,252. So yeah, I think back again to the heavy IT-led profit booking which we saw on Friday. So over the weekend, macro variables pivoted beautifully. So we saw positive progress in the US-Iran peace talks out of Switzerland, which has cool-headed the geopolitical risk premium, which sent international Brent crude prices cracking cleanly below the $80 per barrel mark. So this has triggered massive domestic relief, which is further amplified by a strengthening Indian rupee and a welcome return of FII net buyers. So if we just see the option chain chart, which I have put here. So if we look at this open interest change, we can see first we look at the India VIX, which has cooled down by point decrease of 0.1 to sit comfortably at 12.9. So and the put call ratio is again perfectly balanced as we saw in Bank Nifty, it is around 1. So this tells us that option writers are aggressively writing options on both sides of the chain, setting up beautifully defined institutional ranges for the June 25th expiry. So let's just map out the order flow. So if we directly look into 77,300 strike, so Nifty may have its level, but Sensex is fighting its primary war right here. So at 77,300, we are seeing a major intraday tug-off war. The red bar feature a dominant fresh diagonal strike call writing, as sellers are trying to prevent the index from locking an immediate runway afternoon rally. But look right next to it, if we see a green bar shows a sharp expansion of put writing contracts today. So if you look at the change in both, it's quietly no, there's no a lot difference between put OI change and call OI change. If we see here, call OI has increased by 3.58 lakhs and put OI has changed by increased by 3.2 lakhs. So we need to wait for another maybe another hour to see who dominates. So because the index is currently hovering right at 77,259, this 77,300 level is defining pivot for the session. So if the cash market can put just another 50 points higher and cross this 77,300 threshold, so I'll just show you in the chart. Yeah, so we could see a 77,300 mark here. So wait for the 15 minutes candle to close above the 77,300, and you can also wait to see this 77,300 call decrease and put increase. So if you see a call OI increase and put OI call OI decrease and put OI increase, once you see a 15 minutes candle closes above 77,300, it means that the buyers are defending this zone, and there is a strong aggressive buyers entering here. So we can validate that breakout. So so let's just look higher up the option chain to find out where the institutional market makers have built their main defense lines for the week. So if you look at the 77,500 strike, so we could see here there's a OI increase in call of around 1.44 lakhs, and there's a put OI change of there's an increase of plus 1.87 lakh. So the heavy accumulation of fresh trade contracts tells us that the sellers are utilizing the 77,500 marks as an immediate intraday ceiling to cap quick spikes. So if we look at once you see a break above 77,300, just wait for the price to go to 77,500. If we look at the technical chart, we also see a major supply zone being marked here. So This gives us a confirmation where if price goes to 77,500, we can see a strong reaction over that level. So So if we look at the 77,000 and 77,200, so these two are absolute monsters on the left side of the chart. So we have massive green stripe skyscraping showing an incredible addition of fresh intraday put writing today. So it is keep on adding. So we see put writers are aggressively defending the immediate density of the spot price. So 77,000, which is here, you can see. So this is an absolute iron bedrock base for this expiry cycle. So look at the colossal green tower. It completely towers over the rest of puts. So the institutional message here is loud and clear. Option sellers have locked down 77,000 as a major structural floor. So any random afternoon dip caused by macro noise or micro profit booking will face an absolute wall of institutional buying liquidity between 77,200 to 77,000. So keep eye on this level. So let's have two scenarios for this as well. So scenario one would be a 77,300 bullish breakout. So if Sensex manages to clear and sustain above 77 300 on a 15 minutes buying 15 minutes closing basis, the fresh call writers trapped at this level will have to cover their shorts. So the mechanical buying will quickly propel the index towards 74 450 and 74 77 500 resistance band. So just look for the long setups on a confirmed cross of 77 300 targeting 77 500 as your primary profit booking zone. So this would be scenario one. And the second scenario would be given that PCR is at beautifully balanced at 1.0, the index may simply choose to consolidate its morning gains. If we see a minor pullback, do not panic and short blindly. Instead, wait for the index to drift down uh, towards the heavy put writing zones, which is at 77 200 and 7700. So there's yeah, you can see the support zone as well, and 7700, which is over, yeah, which is over here. If you see the price has exactly reacted this morning, 7700. Right? So look for classic candlestick reversals pattern like a bullish hammer or a engulfing bar around these green pillars to go long, risking just below the 77,000 now bedrock floor. So the structural data on this chart heavily favors the bulls today. Trust your support pillars at 77 200 and watch the 77 trends line. So let the institutional order flow guide your risk management. So this is the analysis for Sensex and OI open interest charts of Sensex. So I hope you guys got a clear view on this. So, guys, we have pasted our software link in the chat box. So, do check it. So, we just saw the option chain analysis, and we also saw our software exactly complemented it. We saw a cluster of zones exactly to the OI increase. So, do check it and let us know your feedback. So, uh, So that's all about change in open interest for all the index. We saw for Nifty, Sensex, and Bank Nifty, and we have also analyzed all the option chain. So we'll just Sushma will be talking about stocks to look for today based on OI increase. So we'll be back in 5 minutes.
Hi guys. As we already spoke about news which actually impacted the today's market in the morning, we started with that, and we'll deep down. We'll dive into that and we'll deep down discuss about what and all news impacted. So it was kind of difficult for IT. It slipped over 6%, and TCS also dropped 3.5%, as I mentioned. And Tech Mahindra also, it fell 2.5%, all triggered by Accenture's guidance, cut rising concerns about demand in the sector. The Sensex closed down about 0.8% on Friday because of that one trigger. The important thing is today, 22nd June, the market has bounced back. Census is up around 400 points and Nifty is back around 24,150. IT stocks, oil, gas are like leading the recovery. The border markets are also participating. And the macro side, crude oil prices have declined, and that's one of the key reasons for the positive sentiment today. Global cues are also supportive. Lower crude, lower inflation pressure, like lower, good for India's current account. Always positive. Sipla, Infosys, Tech Mahindra are all like top Nifty 50 gainers for far for today, which tells you IT is bouncing from its Friday lows. Whether it's dead cat bounce or real recovery, we'll watch. And as I mentioned, the Reliance story, AGM on June 19, which happened because of this massive market story, and Reliance is an index heavyweight. And Reliance is deploying the NVIDIA GB300 GPUs with compute capacity equivalent to more than 75,000 H100 GPUs. The Jamnagar AI facility is expected to eventually exceed uh, 2 lakh, yeah, 2 lakh H100 equivalent GPUs, which would be placed Reliance among the world's largest AI compute platforms. So crude oil. We'll talk about the crude oil. It's falling today. That's direct positive for India. Lower crude is equal to lower import bill. Rupee gets support. If I feel better about India, and this is one of the key reasons for today's bounce. FI situation. We'll talk about FI situation, and we should be honest here. FPIs have been net settles of Indian equities in 2026, with the total selling crossing two, 2 lakh 20,000 crore for far this year. The reasons: elevated crude, inflation concerns, interest rate uncertainty, rupee depreciation, and also absence of strong AI trade in Indian equities. Yeah, so we are diving into straight into open interest spurts. Because of this, where smart money leaves its footprints. As puts tell us where fresh positions are being built, and that's your edge for the day. So let's go. Index snapshot. Yeah. So the first one is Nifty. The bigger OS put on it, today's list is 30.38%. Increase in open interest. Over 25 lakh contracts added. Spot at 24,163. This kind of aggressive build up in Nifty is a clear sign of fresh long positioning. The market is learning bullish today. So the second one is Bank Nifty. Open interest up to 4.15%, with 62,000 plus contracts added. Spot at 57,879. Longs being built here too. But watch how individuals banking stocks behave before taking a directional trade. And mid cap Nifty with 7.07 open interest. This is interesting actually. Mid caps are seeing a strong interest retail and institutional. The broader market is participating, not just large caps. And Fin Nifty three with 3.05 spurts. Financial sector is also seeing fresh positions coming, and the overall bias today is bullish. And I'll be telling you the stocks whichever you should keep your eye on for today. The first tier is with open interest up to 10% plus, which is Oltas 29.27%, nearly 30%. OI build up with the volume crossing 1 lakh contracts. This is not a noise, this is intent. Spot at 1367. We are in peak summer season. AC demand is running strong, and money is clearly flowing into Voltas. This is your sector, then play off the game. Watch for any breakout above recent highs. And second one is Dixon, 10.05% of open interest. 13,000 plus contracts added on this premium stock at point of 12,330 exact spot. So Dixon is a PLI scheme and electronics manufacturing. Also strong order book. This kind of OI build up on a high value stock signals institutional intent and also momentum trade if it break out, and also the strong build up which is like 5 to 10% OI spread. Delivery 9.08%. Logistics is building up at 469. E-commerce and quick commerce growth keeps this name relevant. Fresh OI build added, and also you should watch for a directional move. So yeah, the next one is Blue Star, which having 8.74 OI interest, open interest. Voltas and Blue Star both in the top OI spots today. The cooling and AC sector theme is very alive right now. Spot at 1,658. If you're looking at Voltas, Blue Star is your second name to keep on the radar. And next one is Cipla with 8.57% of OI. So yeah, the next one is Cipla, as I mentioned, which is 8.57% of increase in OI. Let's check Cipla. See, you can see the chart also. Yeah, Cipla, as I mentioned, it gained 8.57% of OI. This seeing action 245 crore in options value plus future build up. This has institutional fingerprints spotted 100402. Cipla is a solid name, not a speculative one. So this build up carries weight actually. The next one is Policy Bazaar with 6.46 of build up in OI. We'll put that chart in. And the next one is PGL with 7.14% of increase in OI. Spot at 563 rupees. Power and infra continues to be a slow burn theme, and OI is confirming interest here. Yeah, as I mentioned, in PGL at the spot 563, it has gained 7.14 of open interest. Power and infra continue to be slow burn theme, and OI is confirming its interest here. And yeah, whatever stocks you should keep an eye on here with a 3 to 5% of open interest. Coforge. Actually, Coforge is kind of genuinely interesting. Friday, the entire IT sector got hammered because of Accenture's guidance cut. So Infosys fell 6%, TCS fell 3.5%. The whole sector was actually bleeding Friday. And at here is Coforge, an IT mid cap with 3,834 contracts being added today, not removed, added. That means someone looked at the Friday sell off in IT and said, you know what, like I'm going to take the other side of this trade in Coforge. And also this deserves respect. Coforge is not your average IT company. They are deeply embedded in banking, financial services, and also insurance tech globally. Their revenue mix is different from TCS, Infosys, and at 1,489. They are not as expensive as large cap IT on a relative basis. And what to watch in the Coforge, what to watch at 1,500 is a key level, and if it crosses and sustains with this OI buildup as a base, you have a real trade here. It's up to you, and keep it on your radar for the today. Also, maybe tomorrow. And the next one is TCS with 2.1% open interest, exact spot of 2,137. I know 2.1% sounds small, but let me put this in a perspective for you. TCS has 5.87 lakh contracts of open interest. It has a future value of over 53,000 crore. when a stock of this size shows even 2% of OI increase, that is actually 12,000 plus contracts being added. So that translates to thousands of crores of fresh positioning. So after Friday's 3.5% fall, someone is clearly buying TCS today. Like this could be two things: either bottom finishing by institutions who think the Accenture panic was overdone, or hedged positions being built. Either way, when India's largest IT company by market cap shows fresh OI buildup, the very next session after a sell-off, like you should pay the attention here. TCS is at 2137. Watch 2100 as the support. If it holds that level with today's OI buildup intact, TCS becomes a candidate for a bounce track, like back towards 2200 plus. And for long-term investors and any dip in TCS below 2100 on fundamentals like this, strictly a buying opportunity. That's just a fact. And the next one is Cummins India. It's, Cummins India makes diesel and natural gas engines, industrial power generation, distribution. This is a pure capital goods and industrial machinery plant. 6.6, it has increased the 6.61 in open interest at spot of 5,746, and also 6.61% OI export with 2,319 contracts added and total value of nearly 240 crore. That's not a real retail noise. That's something building a position deliberately and quietly in a high value. And why you think this matters? India's infrastructure push is still very much alive. Data centers, manufacturing, power backup systems, Cummins sits right in the middle of all of them. And when institutional money quietly accumulates in name like this, it usually means they're playing a medium term theme, not one day trade. And what you think you should watch is, if it holds above 5,700 and volumes stay elevated, this could be a positional setup for a week, not a day trade, but for a week. Maybe a swing trade idea. And the next one is Oracle. And about Oracle Financial Services Software is not talked about enough on most channels. So, and I just wanted to change that today because look at this number, like 4.21% OI spot, like 1,511 new contracts, these are added. Total value of 16,000 crore plus, and it's a premium, and it's a niche IT company. They make core banking software used by bank across the world. Their revenue are sticky, their margins are excellent, and they're not as exposed to discretionary IT spending as TCS for or Infosys. So when the broader IT sector gets hit by Accenture's guidance on consulting and spend, Oracle doesn't feel the pain in the same way. And yeah, that's today's OI buildup is telling you exactly that someone is saying Oracle is being punished for the wrong reasons. That's actually a smart trade. And what do you think you should watch here is 9,765 spot. If Oracle holds about above 9,700 and continues billing OI, this is a strong positional idea for the week. Options value of 2,669 crore also tell you there is a derivatives interest here, not just futures. Okay. So yeah, guys, the next one is PFC, Power Finance Corporation, with OI below of 3.73%, spot at 441. I think you guys can hear me. So yeah, PSU financials. I know some of you go on when you hear PSU, but hear me out. PFC is the backbone of India's power sector financing. Every big power project, thermal, solar, hydro, at some point touches PFC's balance sheet. And with India's massive energy transition underway, PFC's loan book is growing steadily. So 2,601 contracts added today. So total value of 48,745 crore. That is a massive book for this stock. 3.73% OI spot in FFC is not actually small. And the PSU financial team has been going in and out of favor this year. But when you see consistent yeah, OI build up in names like PFC, it tells you the smart money hasn't abandoned the sector. They're just being patient. And what do you think you should watch is the spot 441. Key support is 433, 430. If PFC holds 440 plus with this OI, positional buy for the target of 460 or 470 in the near term. Low risk, steady reward type of trade for this. And the next one is Adani Ports. Yeah, I think you guys can see the chart now. It has increased 3.7% in open interest at a spot of 1,812. Adani Sports in India's largest private port operator, and it's increasingly becoming a full logistic ecosystem. Ports, warehouse, logistics, parks, inland container depots. This is not just the port stock anymore. So 2,870 contracts added today, and total value will be 23,564 crores. The infrastructure theme in India is not going away anytime soon, and Adani Ports sits right at the center of it. And what's more, crude oil falling is actually a double positive for Adani ports. Lower crude means lower fuel cost for shipping and logistics, and it means global trade flows stay healthy, which means more cargo for volumes at their port. And what do you think you should watch? Spot 1,812 maybe, and 1,800 is the key support. And this is a solid swing trade, break below 1,800. Next one is BSC. Yeah, this is a fascinating one. BSC, Bombay Stock Exchange. The exchange itself is seeing OI buildup. So it has increased open interest of 3.45% with the spot 4,001. Think about what that means. When the exchange stock builds OI, its play on market actively itself increasing. More traders, volumes, more listings, more IPOs, more derivatives, and all of that directly benefits BS's revenue. So right now we have a Geo IPO in the pipeline, potentially the largest IPO in an Indian history. We have the market recovering. We have retail participation staying strong through SIPs, direct equity. All of that is good for BSC. 3,045 contracts added. The total value will be 36,335 crore. Someone is building a position in BCI better than the capital markets. Theme continues. So, what do you think I should watch is 4,001 spot. 4,000 is a psychological level, hold above it, and the capital markets play is alive. This one is more of a thematic positional trade than a day trade. Keep it on your medium term radar. And the next one is Patanjali, which is a negative minus 3.8% with open interest spot at 421. So this is the biggest OI unwind for the today's entire list. 1,970 contracts shared, and that is a clear decisive exit of positions in Patanjali. You can see the chart. I have put the Patanjali's chart. So why you think it's important? Patanjali has a mixed year. FMCG competition is intense, and their revenue growth has been under scrutiny, and the stock has been range bound for a while. When you see nearly 4% of OI is being removed in the one session, that tells you whoever was holding a directional bet here has given up on it. And absolutely no fresh longs in Patanjali today. If you are already holding, tighten your stop loss. This is a stock to revive released only when OI stabilizes, and start building a fresh right now. And the next one is Tata Motors PV. Yeah, over 7,173 contracts shared in a single session. This is a significant. TMPV is the passenger vehicle arms of Tata Motors. This kind of y-axis tells you that the near-term momentum trade that was being played here is being unwounded. It could be the profit booking after a recent run, or it could be positioning ahead of a negative view. Either way, the signal is exit, not entry. Auto sector is a whole needs watching. OI data is showing mixed signals. Some names building, some unwinding. TMPV is clearly in the unwind cap today. No fresh positions in TMPV today, but wait for the OI to stabilize over next 2 to 3 sessions maybe before reconsidering. The next one is MCX. So it has decreased minus 1.8% with a spot of 2,854. MC6 India's large commodity exchange, we already know. And ironically, on the day when commodity themes like crude oil are moving, MCX is seeing OI exit. So 1,173 contacts removed, and this is happening alongside reasonable volume of 22,722, which means the exits are active, not just passively expiry related. Someone is derivatively closing their N6 derivative positions today. This might seem counter-relative, but commodity exchange stock falling when commodities are moving. But remember, lower crude oil actually reduces trading volumes and volatility in NCX key contracts, which can hurt their revenue. The OI exit might be reflecting exactly that logic, and avoid fresh long positions in MCX today. And it's not a screaming shot either, but it's definitely not a buyer right now. Wait and watch. You should wait for a while. And the next one is KPIT Tech with negative of 2.43% and the spot of 760. The KPIT Technologies is an auto tech software company and embedded software for electric vehicles and connected vehicles, a niche but interesting space. 1,058 contracts exited in the contest of the broader IT sell-off on Friday, which happened. This makes sense. KPIT sits at the intersection of IT and auto, and when both sectors face headwinds, the stock gets hit from both sides. The OI exit is telling you whoever was playing recovery trade, he is not confident yet. They are stepping back. Wait for clarity in the both IT and auto sector before taking a fresh positions in KPIT. Do not chase it down. The next one is Indian Energy Exchange (IEX) with a minus 2.61%, spot at 126. IEX is India's power trading exchange, and this OI unwind is a bit of a red flag because the power sector itself was showing OI buildup in names like PFC and PGEL. But IEX is going the other way. 984 contracts exited. The divergence within the power sector is important. Money is moving into power financing and power equipment, but out of power trading platform. That's nonce the signal. It's suggests the theme is selective, not broad. Avoid IX for today's fresh trade. And if you have existing positions, evaluate spots carefully before taking any. Irada minus 1.6%, spotted 130. is the Indian Renewable Energy Development Agency, a government body that finances green energy projects. Big theme, right? Yes, but the OIS is not today. 649 contracts exited. IREDA has been on a volatile run, and this OI exit suggests that near-term momentum trade is being unwound. The long-term green energy story is intact, but a short-term, this is a stock where smart money is currently reducing exposure. If you're a long-term investor in IREDA, hold it. If you are a trader looking for a quick trade, wait. The OI data is not supporting fresh entry right now. Give it 2 to 3 sessions to stabilize. Yeah, I'll just give you a detailed watch list summary today. Depending on the OI builder. Voltas, you number one pick today. Summerthing, 29% of OI good. Volume confirmed. Watch 1367. Sector tailwind is undeniable right now. And is to stay away from the Patanjali, PMPV, MCX, KPI Tech, and IEX and IREDA. And you should keep your eye on Reliance, BCE, Adani Ports, PFC, OFSS, PCS, Coforge, Cummins India, Cipla, Dixon, Blue Star, and lastly Voltas. You should keep your eye on all the stocks which I mentioned, and please be careful before investing. Yeah, that is your complete OI analysis for the Monday, that was 26 June 22nd. And let me leave you with three things to remember today. One is the index OI is screaming bullish. Nifty 30% OI spot is not something you see every day. And the market wants to go up today. Don't fight it. Second thing, sector themes are very clear in today's data. Cooling and AC stocks, Voltas, Blue Star, Pharma, Cipla, select IT boom finishing, TCS, Coforge, YFSS, and industrial are Cummins, and Power, PFC, PGL. These are not random picks. OI data is pointing you directly at them. And the third one is Reliance. Is your medium term story. Geo IPO is now officially in motion. That is a narrative that will drive RIL for months. Keep it on your radar, even if you're not trading in today. And always wait for price action to confirm what OI is suggesting. OI is intent. Price is proof. Trade the proof, not just the intent. And if this show added value to your trading day, hit that like button and share and watch daily for the more updates and subscribe so that you can also press the bell icon so that you never miss a single live session, single notification. So yeah, guys, we'll be back in 10 minutes with stocks which are outperforming and which are underperforming with the sectoral wise. Though our expertise will be telling you and analyzing the stocks which are outperforming and underperforming, and we'll be back in 10 minutes here. Just be with us for 10 minutes and we'll be back with new news, updated news. Yeah, in that time, meanwhile, if you have any favorite stock, if you have any, if you've taken any trade in any stock, currently you're trading, taken any positions, let me know in the comments. We analyze and we'll analyze that particular stock, we'll get to know. And we can also check our tool how it's working, and we'll also check your analysis and our analysis and our tool analysis. And also in the description I have mentioned our website, you just go through it, and you just contact us. I also put our website in the description. You just go through it, and also I have mentioned a link in the chat box. You open it and you can contact us anytime, and we'll contact you back, and we'll give you more detailed information about our tool.
So I guess we'll be looking at the yeah. So we'll look at the sectoral heat map and performance breakdown. So the broad market narrative today is dominated by a stunning tech and energy twin engine, pulling the market sharply upward to erase Friday's IT-led connection. So we'll just show you the So let's first start with the aggressive gainers. So when we look at the aggressive gainers, Nifty IT, which is up by 1.29%, trading at 27,780. Okay. So the absolute MVP of the morning session. So after punishing Friday, where the tech pack single-handedly dragged down the index, we are seeing a massive short covering surge. Institutional buyers are treating the dip as a major accumulation zone. So we'll just choose one of the stock and look at the technicals. So we'll take persistent. So we can look at the chart where price has started to show some uptrend. Price has broken the previous structure shift, and it has, we can even see a gap of opening today. So we saw Friday a huge gap down opening. So the market is recovering. So market is currently trading near the broken demand zone, which is currently acting as a supply zone. So wait for the close above it. So we can confirm it by a structure break or a retracement to this resistance level, to this resistance level once it breaks above it. So next sector would be Nifty IT telecom industry. So So if you look at closely, we can see that the Nifty MSIT Telecom has been increased around plus 1.28%, and it is currently trading around 9,571. So closely tracking the large cap IT pack, we are demonstrating that tech buying is broad based and extending into mid small cap telecom names. So we could see most of the stocks in this particular sector is green. So we see the dark green shaded thing. It is means it has a large increase in percentage. We could see there is a 5.49% increase. So this will put the stock in the technical chart. So we can see a strong supply zone break and a trend line break to add confidence to it. So we can see a resistance break here too. So these cluster of zones might act as a strong support here. So wait for the price to retrace around this zone, and you can look for a candlestick pattern confirming the trend. Then you can look for buy positions. So the next sector would be Nifty oil and gas. So a spectacular breakout which has given increase around 1.26%, and which is currently trading at 11,310. So a cool off in crude realities over the weekend has dramatically improved gross marketing margins for oil marketing companies. While there's heavy buying in Reliance industry, which is up over 2% post AGM fund print, which is supercharging the index. So let's also look at the sectoral which are cautiously bullish. So these are aggressively bullish, and we are looking at the next sector which are cautiously bullish. So if we look at the Nifty Pharma sector, so if you look at the Nifty Pharma sector, it has increased around 0.62%. So defensive names are keeping pace with the cyclicals, providing a sturdy, reliable green foundation to the morning era. So if we look at the number of stocks present in this particular sector, we see a steady, balanced performance. We see a few stocks showing a bullish structure and a few stocks showing a bearish thing. So these sector is cautiously bullish. So I might expect afternoon sessions that this stocks might turn bullish. So next is Nifty FinServe, where which is increased by 0.55%. So financial engineering and asset-backed security optimism are pushing specialized finance indices to outpace standard banking trackers. So, but if you look at the stocks which are present in the sector, most of the stocks are showing green. So it's also a bullish sector performance. So just will pick a stock. So if we look at this particular stock, we can see there's a supply zone break here, and multiple resistance have been broken. You could see a strong structure shift as well. So there is a lot of possibilities for this particular stock to break this trend line, and if it holds above this, then you will we can see that there will be a huge momentum once the price holds above this line. So the next one is Nifty Reality. So bouncing back strongly to hold its ground right above key short-term moving averages. So it's up by 8. It's up by 0.58 percentage, which is currently trading at 816. So Nifty Metal, which is currently trading around 0.56 percentage, which it is increased by 0.56 percentage and currently trading at 30,093. So it is benefiting from global resources, and it is stabilizing, and there is a steady domestic capital expenditure as well. So the outlook of Nifty Metal is also considered as bullish. So we could see that most of the stocks in this particular sector are performing bullish. So the next one is Nifty Auto. So there is a stable measured recovery after facing a mild headwind pressure late last week. So it's up by 0.42%, and it is currently trading at 26,695. So if we look at the Nifty Auto sector, we can see only except one stock, one particular company, all the other stocks are performing well. So even there's a huge scope for this sector to be bullish. So considering considering sectors which are in a flat line or a consolidation zone, we would take the Nifty Bank, which is up by 0.39%. Private banks are holding steady, keeping the benchmark stable, but letting IT and energy take the direct line right to right. So the next one is Nifty Cement, which is up by point plus 0.02%. So the stocks so exhibit this shows exhibiting quite neutral and consolidation with negligible institutional movements. We can see that there is a slight change, 0.9%, 0.7%, 6%, except this particular stock we got 2.57%. So these are the sectors which are flatline and which is in consolidation zone. And let's look at the sectors which are in negative territory. So Nifty FMCG. So it is decreased by minus 0.07%, which is currently trading around 49,526. So there's a minus negative friction. Capital is visibly rotating away from safe haven consumers. No, and it is shifting aggressively into high beta growth packs like IT and energy. So if you look at the stocks which are present in this particular sector, most of it are showing bearish structure. So there's a slight profit booking in the mid tier as well. So let's just move to Nifty Health. So we can, if we look at this, there is a decrease in 0.13%, and we can see there is a slight profit booking in the healthcare. Names as money rotates to large cap pharma. So even this particular sector falls in negative territory. So we could see there is only a slight increase in these stocks and a huge fall if you look at this 1%, 1.47%, 5%, and 2%. So we'll just look at the next sector is Nifty consumer durables, which is down by 0.45%, and it is facing a margin pressures and distribution rebalancing, just forcing tactical traders to unwind their long-term bets. So the broader market is proving that it has an exceedingly strong spine, where the market can experience an absolute rot in IT on Friday, and immediately respond on Monday with a 1.29% tech surge alongside a rolling oil and gas sector. It indicates deep structural liquidity. So the primary strategy for the remainder of the session remains a strict buy the dips approach and across IT and energy, using the underperforming consumer durable pack as a funding source for the momentum trading. So this is about the sectoral analysis. So hope you got a clear picture on sectors which are outperforming and underperforming. So meanwhile, we'll just look into the stocks which are performing based on fundamentals. Uh, we'll be back in another 15 minutes and we'll be explaining about the stocks to look for purely based on fundamentals.
Hello everyone, welcome back to the channel. Today we are going to analyze one of the India's strongest specialty companies, that is Pidilite. So most people of you may not recognize this company name immediately, but almost everyone has used its products. Brands like Fevicol, Fevikwik, Mr. Fixit, or M-Seal, these have become the household names across India. So in this video, in this session, we'll understand Pidilite's business model, analyze its fundamentals, identify future growth drivers, and discuss its key risks. So currently, Pidilite is trading at around 1,560. So now we'll go into screener. So first we'll understand Pidilite's industry's business model. First segment is consumer and bazaar products. This is the largest revenue contributor. Products like Fevicol, Fevikwik, M-Seal, Dr. Fixit. These are the products that are sold through massive distribution networks of dealers, retailers, hardware stores, paint shops, and construction material suppliers. So, why this business is powerful is that normally when a carpenter purchases any gum or adhesives, they directly you ask for Fevicol instead of asking wood adhesive or wood gum. So this is called brand substitution. So second segment is construction chemicals. Uh, Pidilite is well versed in segment such as waterproofing products, tile adhesives, repair chemicals, and protective coatings. And these brands include Dr. Fixit, ROF, and Pidicrit. So as India's real estate and infrastructure is in boom, this demand for these products also increases. And next segment is industrial products. So Pidilite also supplies adhesives and specialty chemicals to packaging companies, furniture manufacturers, footwear companies, and automotive manufacturers. So these products are often customized based on industrial applications and depending upon the suppliers. So let's now look into fundamental analysis. Uh, See, the current market cap of Pidilite is 1,59,053 crores, and the current price is around 1,563. If you look at the stock PA, it's around 64.7, which is high compared to industry median. So now, if you look into the revenue growth, see, you can see the sales growth. It's been in a constant increase. The sales have grown from approximately 4,844 crores in 2015 to 14,601 in March 2026. So that's almost nearly 2.7 times increase in last 10 years. And the company has delivered 10-year sales CAGR of 11% and 5-year sales of 15%, 3-year CAGR of sales CAGR of 7%. So now if you look into the profit, the net profit has increased from 514 crores in FY15 to 2471 crores in March 2026. So profit has grown more than almost 4 times over the decade, and the profit CAGR is around for 10 years is around 12%, and in 5 years it's 17%, and if you look into 3 years, there has been 25% of CAGR, which is comparatively high compared to its competitors. Now we look into margins, operating margins. See in FY25, it was around 16%, and in March 2020, it's around 24%, which is almost 8% increase. So this shows that the margins has expanded significantly. So the reasons for this expansion is strong branding power and even pricing power, premium product mix, better operating leverage, and the company has also enjoyed a luxury of lower raw material cost in some periods. And if you look, the company has been maintaining around 20% median operating margins for almost 10 years, which demonstrate strong competitive advantages. So now if we look into return ratios, the ROE for 10 years is 23%, and for 5 years is 22%, and 3 years is 23%. So it's around average of 22 or 23%. And these are excellent numbers. Generally, if you look into mathematical calculations, ROA above 15% is considered strong, and ROC is above 20% is efficient. Uh, so Pidilite consistently exceeds both. So this means management generates substantial profits from shareholders' capital. Now we'll look into balance sheet. First, we'll look into debt. But if you look into that, it's been negligible compared to its market cap. Long-term borrowings has been nil. There only short-term borrowings has been increased, but it's not significant. Uh, if you look into the debt equity ratio, it's around 0.04, which is negligible. So what is the advantage of this debt-free fund is that it can enjoy advantages such as low interest burden, lower financial risk, more flexibility during economic turnouts. So strong balance sheet often helps companies survive during difficult periods better than its competitors. So, and if you look into the fixed assets, there has been constant increase from 978 to 540, 5774 in 2026. It shows that the company is has constantly increased its fixed assets and focusing more on capex. Uh, Now we'll look into cash flow analysis. So operating cash flow for FY25 is 2000, 2026 is 2828 crores, and the free cash flow for FY 2026 is 2239 crores. So CFO by to operating profit is around 100%. This is extremely healthy. It means profits are converting into actual cash rather than remaining only in papers. So a strong cash flow So strong cash generation allows dividend payments, acquisitions, and expansion. So without requiring significant debt. And net cash flow has been in negative, but this is not something negative perspective of the company. If you look at the in investing activities, the company has made a significant purchase of fixed assets and also purchases of investment. It's around 6,386. And if you look into financial activities, the company is been focusing on dividend payments. So the company has paid 1,526 crores dividends worth of dividends in March 2026. So now we look into ratios. So in the company has maintained average data days of around 45 to 50, and inventory days has been increased to 98 compared to previous year, which was 103. So even the days payable has increased, but which is this is not an significant risk factor. And the conversion cycle has also been increased to 66 days, which indicates that company is able to bring in cash to the company in 66 days. So the working capital days has been increased this year, which is due to uh, lower demand, construction demand. So ROC there is around 31%, which is excellent numbers. So shareholding patterns, you can see promoters, it's constant percentage. FIS has increased, but this year it's low. And DIs, there is a constant increase in DIs. So now we'll talk about growth drivers. What are the growth drivers that will help Pidilite to grow in next 5 to 10 years? So first is housing and real estate growth. So whenever if you see a house is built, products like adhesives, waterproofing chemicals, tiles adhesives, sealants are required. So now Indian housing demand remains constantly strong due to urbanization, rising incomes, nuclear families. So Pidilite directly benefits from this trend. The next growth driver is waterproofing opportunities. So India still has a low penetration of organized waterproofing products. So many buildings face leakages issues. So as awareness increases, the waterproofing becomes necessarily rather than optional expense. So Dr. Fixit is one of the strongest brands in this category. The next growth there is premiumization. So customers increasingly prefer branded products over local unorganized alternatives. So this shift helped Pidilite increase their market share, improve margins, and launch premium products. Another growth driver is that rural expansion. So the company continues to expand its distribution in smaller towns and rural markets. So as income rises in rural India, so demand for brand constructions, home improvement products will increase. So next is the company is focusing on international expansion. So Pidilite operates in multiple international markets. So while India remains the main growth engine, but overseas market also provides additional opportunities for Pidilite. And the last growth driver is government infrastructure spending. So the government is largely investing in roads, railways, metro projects, commercial buildings. So this increase in construction, chemicals, and specialty products helps Pidilite to increase its revenue and market share. So this creates a long-term structural opportunities for Pidilite. So the last we'll come up to the last segment, which is the key risk. What are the key risks involved in Pidilite? So the major key risk is the raw material volatility. As you know, Pidilite uses petrochemicals derivatives as its raw materials for creating all these chemicals. So crude prices increase can impact gross margins and operation margins. And as currently war is going on and global market is uncertain, which can affect its gross margins. So if the company cannot pass its cost to customers immediately, it will have an impact on gross margins. So rising competition. Next risk is the rising competition. So as you know, Asian Paints, Berger Paints, and other companies are entering into chemical and adhesive businesses. So competition from Asian Paints, Berger Paints, construction chemical companies, and regional adhesive manufacturers in waterproofing and construction chemicals. So this increases competition. Uh, and the next risk is slowdown in real estate. As you can see, consolidation in real estate sector. So the prolonged slowdown in housing or construction activity can impact demand. So since inflation is little high in recent months, so there is a slowdown in housing and construction activities. So since many products are linked to construction activities, economic weakness can affect the growth. And the last is execution risk in new categories. Pidilite is expanding beyond adhesive into broader construction solutions. So any failure in scaling new categories could affect growth expectations. So this is all about Pidilite Industries.
So one of the viewer had asked about Sun Pharma Advanced Research stock. So if we look at the technicals, the price is currently it has broken the trend line. It has regained this trend line level, and it is currently trading near the supply zone here. So our our software has also generated a buy signal. So previously we had got around 8%. So currently the market is retesting this resistance level, support level, which it broke before. So let the price regain above this trend line. So wait for the price to uh, regain above this trend line, or let it break this supply zone. So once the price closes above this level, then you can look for long positions. So if we switch it to shorter time frame, we'll still have a clear picture about it. So we had got a buy signal here. So we have achieved around 13%. So the price is currently trading near this. It has broken the trend line in the shorter time frame. So it is trading near the resistance level. So yeah, we'll wait for the price to regain above this level. So which is around 248, 248. So yeah, so if we look at the 15 minutes, we get a shorter time frame supply zone here. So let the price close above this, so that will be look at the price action and confirm it with price action and go for long positions. Hope you got a clear view on Sun Pharma Advanced Research Company. Hope you got an understanding on this particular stock. So let me know in the comments if you have any doubts regarding this. So our team will be continuing with the stocks to look for today, purely based on fundamentals.
So, hello guys, welcome back to the channel. So today we are going to analyze about the more fundamental stock. So one of the biggest renewable energy company. So that is Adani Green Energy Limited. So we'll be looking at the fundamental analysis of Adani Green Energy Limited. So when you look about the stock performance, it was 3 months ago. It was trading around 800 and 866 on March 2016, 2026. Now it is almost trading around 1580. So it almost gives 60% return in just 3 months. So Adani Energy. So the company has the largest renewable energy producer in India and also among the fastest growing green energy companies globally. But the main question is Adani Green Energy fundamentally strong, and is it highly valuation justified, or and it can continue to deliver a growth in future? So let's look at the questions for this. So Adani Green Energy, so incorporated in 2015, is a holding company of several subsidiaries carrying business of renewable power generation within the group, and it is primarily involved in renewable power generation and other ancillary activities. So the current market cap of Adani Green Energy is around 251 crore, 359 crores, and current market price is around 1,526. So the 52 high is around 1,545, and the 52 low is around 756. And when you look at the stock P, it is at around 137, which is trading above the industry PE. So we'll be discussing further about why the stock is trading at 137, and the book value is around 121, and the return on capital employed is around 7.39%, and the return on equity is around 9.4%. So the company develops and owns and operates solar power projects, uh, and wind power projects, and hybrid renewable energy projects. So its business model is relatively simple. So Adani Green Energy Limited builds renewable energy plants and sells electrical through long-term power purchase agreements known as PPAs. So to state electric boards, government entities, commercial customers. So the contract generally have tenure of from 20 to 25 years, which provides predictable revenue and cash flows. So the company is aggressively expanding in its renewable capacity and aims to become one of the world's largest renewable energy producer. So when we look at the industry overview of Adani Green Energy Limited, so these are the peer companies in the power sector and the power generation. So that is NPTC, National Terminal Power Consumption, and Adani Green, JSW Energy, NPTC Green Energy, NHPC Limited, NLC India, and SJVN. So these are the peer companies which are operating in the power sector. So when we look over the peer comparison, so in market cap, Adani Green Energy Limited is at the second. First is at NTPC. And when we look at the peers, P ratio, which the median P ratio is around 28.18, but the Adani Green Energy P is trading at 137.29. We'll be further discussing why the Adani Green Energy is trading at 137 P ratio. When we look at the dividend yields, almost all the companies in the power sector is not paying much dividend to the companies, even though they are generating the massive profits. So next, when we look at the company's return on capital employed, it's around 7.09%. Industries and the company is giving around 7.39% return on capital employed, which is fairly up to the industry. So when we look at the industry overview, so Indian renewable energy industry is a massive inflection point. So India aims to achieve 500 gigawatts of non-fossil fuel capacity by 2030 and net zero emissions by 2070. So this means that investment will flow into solar power, wind power, energy storage, and green hydrogen. So being one of the largest player, Adani Green is well positioned to benefit from energy transition. So this is one of the biggest growth drive for the company. So when we look about the, so this is the quarterly result of Adani Green Energy. So these are the sales from quarter March 2023 to March 2026. Operating profit, profit before tax, net profit. So we'll be discussing about the income statement of yearly wise. So when we look about the sales, the company's net sales was around 28 crores in the financial year 2016. It was almost grown to 12,928 in March 2026. So it was, we can say that it was almost grown around 33 point CAGR. So this was growth was mainly driven by capacity addition, new solar and wind projects, increased power generation, and long-term power purchase agreement. So this was the main reason the company has grown sales from 28 crores to 12,928 crores. So when we look at the expenses, so it was almost grown from 14 crores to 2001 and 14 crores, and operating profit is around 13, which has increased from 13 crores to 10,785 crores. So the expenses in these companies are very quite low because it is a capital intensive company. So there won't be much expenses regarding the cost of goods sold. So when you look at the companies, when you look at the company's operating profit margin, so the company's operating profit margin is around 83%. So when we look at operating profit margin from over 2016, it has grown from 48% to 83%. It's very quite good. So when you look at the company's peers, industries operating profit margin, the median operating margin is trading around 35.55%, but the Adani Group Energy operating profit margin is growing around trading around 83%. It's quite good. So this could be benefit from the operating leverage. So when you look at the profit before tax, it was almost trading on the negative 9%. It was grown to 2001 in financial year 2026. And when we look at the net profit, it was almost around 9% So even this has been grown from my negative 9% to 1,987 crores. So So the it was almost around 70% CAGR from minus 9 crores to 1,987 crores. When you look at the EPS of the company, it was almost around minus 58 rupees per share. So it has almost grown to 10.03 per share. So when you look at the dividend payout ratio, it is almost 0% over the all period of time, which is the red flag for the company. Even the company is generating around 2,000 crores profit per year. It has not paid any dividend for the shareholders. When you look at the component sale growth of the company, it was almost around 85% for 10 years, and for 5 years it was 33%, and for 3 years it 18%. So when you look at the component profit growth, for 10 years it is almost around 70%, and for 5 years it is 44%, and for 3 years it's 17%. When you look at the stock price CAGR, so for 5 years it is almost around 6%, 5%, and for 3 years it is 60%, and for 1 year it's 59%. When we discussed earlier, so the stock has almost given a return on from past 3 months is almost given a return of 70% from 815 rupees per share to 1,500 rupees. So when you look at the balance sheet of the company, so when you look at the profit, the most impressive metrics about the profit, operating profit margin is it was trading around 83%, which we has already discussed. Why the margin is so yes because because the fuel cost is almost zero for the company, so which is the operating leverage for the company, and the operating expenses remains relatively low compared to other sectors, and the most costs are fixed in the nature. So there is a fixed cost in the company, so there is a operating leverage benefit. And when you look at the interest cost, it is almost increased from 23 crores to 6,884 crores. This is mainly because the company has increased the borrowing from 4 crores to almost 1 crore. We'll be further discussing why the debt has been increased from 4 crores to 1 lakh over a period of time. And when you look at the balance sheet, the the equity capital is around was trading around 160 crores in 2016, has been increased to 1 lakh 1,647 crores. But when you look at the reserves, it was almost at minus 9 crores. But the company has maintained a enough capital reserves up to 18,318 crores in March 2026. But the company did not pay any dividend for the shareholders, even it has been maintained 18,318 crores. So when we look at the borrowings, the company has increased the borrowing from 4,132 crores to 1 lakh 3,544. This is the red flag which we need to analyze why the company has been increased from 4,000 to 1 lakh crores. So when you look at the long-term borrowings, it has been increased from 3,500 to 87,000. And when you look at the short-term borrowings, it has been increased from 5,591 crores to 12,000. And the company has also made a lease liability of from 375 crores to 3,000. And when we look about the fixed assets, even the fixed assets has been increased from 2,700 crores to 1 lakh 2,000. So this indicates that the company had made a uh, capex over a period of time. Next, when we look at the ratios, so which already discussed, the return on equity is almost around 11.4%, and the ROC is around 7.39, which is almost the return which is given by the industries. And these numbers are not very impressive because the company has invested massive capital into new projects. So many projects are still under the development and are not fully generated the returns. So this is why the return on capital employed and return on equity is less compared to other industries. So when we look at the cash flow analysis, so cash from operating activities. So it has been increased from 28 crores to 10,135 crores. So this is a positive and growing, which is a good sign. So however, free cash flow remains negative. So we can see the free cash flow has been negative over a period of time from negative 889 crores to 15,857 crores. So this is because the company is spending aggressively on new solar plants, wind farms, and transmission infrastructure. So negative free cash flow is acceptable during an expansion phase, but does not mean that the company continues to depend on debt and external funding. So this we need to look before investing in the stocks. And when you look at the valuation, now the stocks trade at 137 times PE. So where the industry's PE is around 28.18, but the stock is trading at 137.29. So the valuation are extremely expensive compared to traditional utility companies. So this is mainly because the company is going a massive growth opportunity. So the India wants 500 gigawatts of non-fossil non-fossil fuel capacity by 2030, so net zero by 2070. So renewable energy demand is expected to grow significantly. So this is why the market expect Adani Green to be the one of the biggest beneficiary, and earnings are expected to grow rapidly. So when the new project becomes operational, revenue rises, fixed costs are spread over a large base, profits can increase much faster, and strong parent group backing. So being part of Adani Group gives investor confidence regarding project execution, access access to capital, ability to win large projects. So, but these are the risks. So, IPE is justified only if the growth drives. So, if project execution slows and interest rates rise sharply, debt becomes difficult to service, earning growth disappoints. So, the PE can contract significantly. So, so this is one of the analysis we need to look before investing in the stock, because the stock is already trading around 137 P ratio. And we also told that we'll be discussing about why the borrowings have been increased from 4,000 crores to 1 lakh crores. So the main reason is that renewable energy is a capital intensive business. So to build a solar or wind project, the company has to spend huge amounts. So they need to acquire a land, solar panels and turbines, transmission infrastructure, grid connection, so energy storage system. So a single gigawatt of renewable energy capacity can cost thousands of crores. As a result, so the companies usually finance projects through debt, and even the aggressive expansion strategy. So Adani Green has been expanding its capacity rapidly over a last few years. So when we look at the borrowings, it has been increased from 4,132 crores to 1 crore 3,545 crores. So the company is essentially borrowing totally to build asset that will generate a cash flow over the next 20 to 25 years. So this is similar to like they're building like planning to build like airports, toll roads, power transmission business. So where debt is naturally high. So even the long-term power purchase agreement. So as we discussed that the so as we already discussed that company operates in power purchase agreements. So banks are willing to lend because Adani Green has a long-term contracts with state electricity boards, government entities. So banks are willing to lend money for the companies. So these revenues are relatively predictable. So lenders are comfortable financing these projects. So negative free cash flows. So even though operating cash flow is positive, that is around 10,135 crores. The company has kept investing heavily in the new projects. So therefore, operating cash flows is less than the capex. So when you look at the capex, they were made almost up to 1 crore. I mean 1 lakh 2 crore, 1 lakh 2,000. So it has been massively invested in the plant and machinery from 2,294 crores to 1,007 crores. Next, when we look at the ratios, so the debtor days has been decreased over a period of time from 850 crores to 850 days to 60 days, which is very quite good. And there is no much data available on inventory days and days payable. And even the cash conversion cycle is around 850 days to reduced from 850 days to 60 days. And the return on capital employed is around, it has been increased from 2% to 7%, which we already discussed that the company is almost generating a return on capital employed around 7.39%, where the industry's return on capital is around 7.09%, which is above the industry return on capital employed. And when we look at the shareholding pattern of the company, so when we look at the promoters, it has been increased from, in the quarterly, it has been increased from 56% to 62%. But when you look at the yearly, the promoter has been decreased from 86% to 62% over a period of time. And even FIS has been increased over a period of time and decreased during the last two periods. So when we look at the key risk for the companies, So one is which we already discussed, that I debt. So it is almost exceeding around 1 crores. So this cost interest rate risk, as the company is paying almost 6,484 rupees as interest, and execution risk delay in the project's commission can impact earnings, and regulatory risk changes in government policies may affect the profitability, and even the valuation risk, which we already discussed, that the company is trading around 137 P ratio, and we look at the advantage. The company's median sales growth is around 31.4% over the last 10 years, but the disadvantage is that the company is trading around 12.5 times its book value, and which you already discussed, that the company is not paying any dividend even though it is generating the repeated profits, and the company has low interest coverage ratio, so they are unable to pay the debts which they are taken. The tax seems very low compared to other companies, and the company has a low return on equity of 13.1% over the last three periods. And the company might be capitalizing the interest cost. So So finally, concluding that the positive for investors to be consider investing in Adani Group Green Energy is that industry leader in the renewable energy. So when we look at the market cap, it is almost on around the second companies in the power sector, and the strong revenue and profit growth, which we already discussed, that it has been almost grown profit from minus negative 9 crores to almost 2000 crores, and huge long-term industry opportunities, and long-term power purchase agreement. And when we look at the negatives of the companies, like the investors should look before investing in these companies, that is it is very high debt company, and negative free cash flows, and expensive valuation, which is almost trading around 137 E ratio, and low return ratio compared to all other companies. So by concluding, I can say that Adani Green Energy is really high growth renewable energy store with high leverage and high valuation. It may suit investors who are willing to take long-term horizon, who believes that Indian renewable energy is going to transition, but conservative investors should closely monitor debt levels and valuation before investing. So we hope you enjoy the fundamental analysis of Adani Group Energy. So don't forget to like the video, subscribe the channel. Please let me know in the comments which company would you like to analyze next. Thank you for watching. I'll see you in the next video.
Hello everyone, welcome back to the channel again. Now we'll analyze one of the India's largest diversified conglomerates, that is Grasim Industries Limited. It's a flagship company of Aditya Birla Group. I'll just open screener, Grasim Industries screener. So you can see the market cap of Grasim Industries, which is 2,15,944 crores, and the Grasim Industries is currently trading at around 3,173, and the stock P is around 42.5. So before going into the fundamental analysis, I'll just talk about Grasim Industries business model, business segments, fundamental analysis, then growth drivers, then key risk as usual. Uh, so if you talk about Grasim Industries background, so it was founded in 1947, which is a flagship company of Aditya Birla Group. So it is evolved into diversified conglomerates, both organic growth and strategic investment. So Grasim major businesses includes Ultratech Cement, uh, financial services through Aditya Birla Capital, chemicals businesses. So Grasim Industries is one of the leading manufacturers in caustic soda, alkali products and specialty chemicals. And it also involved in viscose fiber business. So this viscose fiber is a synthetic fiber used in textiles. And recently, a few years back, the company entered into even paint business through Birla's Focus. So the major revenue sources are cement, where Ultratech contributes significantly to overall value of Grassims. So in chemical industry, it produces caustic soda, which is used in textile, papers, aluminum, water treatment, and it also produces viscose fiber, which is usually used in fashion, apparel, and home textiles. So, and it also provides financial services through Aditya Birla Company Capital, which earns through lending, insurance premiums, mutual fund management fees, and wealth management. And recently, as you know, it has entered into paint industry through Builders Opus, and it aims to gain market share in India, worth of 80,000 plus crore paint industry. And this could be the major growth engine for the next decade. So now we'll look into the fundamental analysis. So as you can see, the sales, there's a constant increase in sales growth. And in 2015, it was around 31,734 crores, and it has increased to 1,75,431 crores. Uh, the and 1 lakh, and this reflects a strong business expansion. Uh, and if you look into the compounded annual sales growth for the recent annual growth rate is 18%, and in the last 3 years it's around 14%, and both 5 and 10 years it's around 18%. So this indicates the company has provided consistent long-term growth. So next, if you look into profitability, the company has increased its profitability from 2,582 crores in 2015 to 10,300 crores in March 2026. So this is a significant improvement. So this is 38% year-on-year growth, profit growth. So, but investors should also note that the profit growth is volatile due to cyclical business like cement, chemicals and fire. So cyclical business means that these businesses like increase its revenue and profitably during economic expansion, and there will be decline in profitability and revenue during economic slowdown or downturn. So these are cyclical businesses. So now if we look into operating profit and operating profit margin, so it has increased. If in 2025, if we look into the recent years, 2025 it was 19%. So again, it has come back to 21% in 2026. So this margin improvement indicates better operating leverage, strong cement profitability, recovery in chemical businesses. So now if you look into return on equity, last year it was around 5 years. In 3 years, it provided ROE of 5%, and in 5 years, it has provided on 7%, and which is same in 10 years. But we should not look into isolation because uh, Grasim Industries operates in multiple businesses, and this low ROE is also because of the recent. If you look in the last year, it's 5%, which is considered low from last 5 years. This is because due to expansion in paint businesses. So once the capex and expansion is completed and the revenue is realized, the ROE will gradually increase. So this will happen in next few years. So if you look into the valuations, company valuations metrics, the company stock P is at 42.5, market cap of 2.15 lakh crore, and EV EBITDA 11.6, and the PV ratio for 2.07x. So the stock is not cheap based on its earnings. So investors are paying for future growth, paint business potential, ultratech value, and financial services growth. So the valuation assumes that successful execution of new businesses will increase the value of the business. Uh, Next, we'll look into balance sheet. So the total debt is around approximately 2.28 lakh crores, and debt equity ratio of 2.26. So the debt appears high, but you need to also understand that Grasim Industries are uh, consolidate subsidiaries and financial businesses. So investors should monitor debt levels carefully by analyzing the Grasim Industries subsidiaries separately in isolation. So especially while companies investing aggressively in paint and expansion projects. And as you can see, the fixed assets has been uh, increased significantly. This is due to high aggressive expansion in paint industries. Uh, Next, we'll look into cash flow analysis. So one of the area of concern is cash flow. You can see in recent years, the free cash flow is negative. Uh, how the free cash flow is calculated by subtracting capex from operating activities. So since this is negative, it shows that the company has done a lot of high capex, and this recent year slowdown is due to a heavy investment spending, and as you can see, there is a lot of investment purchased here, and even fixed assets. So this is primarily due to paint business investments, capacity expansions, and growth projects. So this negative free free cash flow is acceptable only if the Grasim industry is able to generate sufficient returns for for the investment done now. So we need to wait in the next few years whether the company is able to convert this investment and create a shareholders value. So if you look into ratios, the data days is completely low. But as I said before, we need to look into other like each segment separately, because paint industry has a different data days, and chemical has a different data day structure. So each segment has its own structural advantages and disadvantages. So even the inventory days is has been reduced significantly. And if you look into the cash conversion cycle, the company is able to convert its cash and bring in cash into the company in nearly 1 day. And the working capital days is negative, which says that the company is able to efficiently circulates its working capital needs. So if we look into promoters holdings, it has been constant for last decade, but in previous year it has been increased in a few points. FIS has also increased, but it's not a negligible percentage, and DIAs are decreased, but which is not a negative factor. So now I'll talk about growth drivers. What are the growth drivers which will help grasim industry to increase its company value? So first is the massive infrastructure spending. So India, as you know, India is a emerging market economy. India continuously invests in heavily in roads, railways, metro projects, and urban developments. So this directly benefits two business segments. That is, one is the ultratech cements, and another is the paint industries. As construction requires both cement and paint materials. So infrastructure remains a long-term structural growth driver for grassing industries. Next growth driver is the housing demand. So as you know, Indian housing market continues to grow due to urbanization, rising incomes, nuclear families. So more homes means higher demand for cement, paints, and construction chemicals. So grassing benefit from multiple categories like paint, cement, and construction chemicals. So the third growth driver is Birla's Opus Paints expansion. So this is the next decade's biggest growth story. As the Indian paint industry, as you know, the Indian paint industry has been dominated by the Asian paint for decades. But after the arrival of Birla's Opus, it has been able to gain around 6 to 7% market share. And if you look into Asian Paints market share in 2023, it was around 59%, and currently around in 2025, it has been reduced to 52%. So approximately, yeah, the Asian Paints has lost 6 to 7% market share to Birla Opus. And this is due to as grasim industries invested aggressively in manufacturing paints, dealer networks, and distribution. And it has used strategies like providing free tinting machines to dealer networks to expand its distribution. So if the Birlas Open captures a meaningful market share, so it could significantly increase Garcim's earnings over next 5 to 10 years. And another growth driver is financial services growth. So India remains unpenetrated in insurance, wealth management, and asset management. So as financialization increases, Aditya Birla Capital can benefit from rising demand for financial products. And in last recent periods, you can see there is a recovery in chemical cycle, and there is a demand for specialty chemicals, and many companies are spending and investing a lot in R&D to expand its specialty chemical portfolio. So if the chemical prices recovers more, the grasim industries chemical segment can contribute higher profitability. So now I'll talk about the key risk. So the first key risk is paint business execution risk. Even though the business builders focus has gained 6 to 7% market share in last few years, but we also need to see that Asian Paints holds a strong market share and has been a leader for many decades. So the company is investing thousands of crores in paints. So if the market share gains slower than expected, so the ROE and ROCE may remain weak. The profitability could also be impacted. This is one of the biggest execution risks. Next is the high debt. Debt has increased significantly over the years due to expansion and fixed assets investment and capex. So if the interest rates remains high or the earnings did- is not up to the mark, leverage could become a concern. So another one of the key risk is cyclical business. So many of the grassy industries business are cyclical, like cement, chemicals, viscose fiber. So economic slowdown can impact its earnings. So if the economic slowdowns, even the even the revenue and profitability of cyclical businesses decreases. So next is the competitive intensity. So company faces high competition in each business segments. Like in cement, competitors are Sri Cement, Ambuja Cements, and in paint industries, you can see Asian Paints, Berger Paints, Kansai, Nerlac, and in financial services, it faces competition from Bajaj Finance, HDFC Group, ICICI Group. So this competition can put pressure on margins. So other last key risk is low return ratios. So the gas and industries provide a ROE of 5% as we've seen before, and ROC of 8%, which indicates the capital efficiency is still below the ideal levels. So we need to wait until the investment matures and the capex turns into realizable revenue, generates realizable revenues. So this is all about grasim industries. So if to conclude, grasim industry as a long-term growth story rather than pure value stock, and the market is betting companies' investment mainly on paint and other industries like chemicals, cements, and financial services, which will generate significantly higher earnings over the next decade. And so since uh, Birla Sopers is biggest reason for many investors are interested in Grasims, I just provide a detailed analysis on Birla Sopers. So if you see the last few decades, the Indian decorative paint industry has been historically dominated by Asian Paints, Berger Paints, and Kansai Nerla. So, Grasim Industries entered the industry in 2024 under the Birla Sopas brand with an investment around 10,000 crore, making it one of the largest greenfield investments ever in global paint industries. So, the management has targeted around 10,000 crores revenue within 3 years of full scale operations. So, as I said before, the Birla Sopas has gained 6 to 7% market share in last few years, And the few key achievements of Birla Sopas are the market share gains have been constantly increasing, and Birla's Sopas has established its presence in across more than 10,000 towns, and over 7.7 lakh painters are already using its products. And the company has expanded its dealer and distribution networks by providing free tinting machines. Um, and if management in the recent con call analysis, management also indicated that Birla's Opus continues to gain market share every quarter, and the revenue growth has been running at nearly three times of the industry growth rate. So the combined market share of Birla's Opus and Birla's White Putty expanded by more than 3,000 basis points year on year. And one of the a major competitive advantage for grasim industry is that its manufacturing strength. So grasim industry has already commissioned multiple paint plants and now commands and holds around 24%, roughly around 24% industry capacity, making Birlas Open currently the second largest decorative paints player in terms of capacity. So why, if we look into why builder swappers can become a game changer for grasim industry is that the paint business is attractive because of its ROE and ROCE. So high brand loyalty, strong cash generation, asset-light distribution, long-term financing demand can help builders successfully capture 10 to 15 market 10 to 10 to 15% of market share in next few years, which can become a multi thousand crore profit engine for Grassins. But we also need to look into the risk in Birla Opus. Investors should also remember that the business is still in investment phase. So if the company is able to, if company is not able to generate revenue or realize revenue even after high capex, then the ROE and ROC will decrease. Uh, and it can also lead to lower profitability. So, to conclude, Birla's Opus has exceeded expectation in last initial years, but we also need to see how the company is able to turn its investments into realizable revenues. So, this is all about analysis of grasim industry and Birla's Opus. So now we'll take a 5 minutes break for next company analysis.
Hello guys, welcome back to the channel. So today we are analyzing one of the biggest creators in the FMCG space, that is Varun Beverages Limited, uh, the largest PepsiCo bottling partner outside the United States. So we'll be discussing the fundamental analysis of the Varun Beverages Limited. So we'll look into that. So I open the screen app to analyze the fundamental analysis of the Varun Beverages Limited. So Varun Beverages Limited has been associated with PepsiCo since 1990s. It is a key player in the beverage industry and one of the largest franchises of PepsiCo in the world. The company produces and distributes and with a wide range of carbonated soft drink, non-carbonated drinks, and packaged with water, sold sold under trademarks owned by PepsiCo. So PepsiCo brands produced and sold by the company include Pepsi, 7 Up, Mirinda, Orange, Mountain Dew, Tropicana Juice, and many more. So we'll be analyzing this company. So over the last 10 years, the company has transformed from the regional bottler into global beverage chain operating across India, Africa, and several international markets. So revenue has grown up around 2,500 crore in 2014 to 22,000 crore, 28,000 crore in 2025, while profits have increased from losses to more than 3,200 based on the financial data provided. So first we'll be analyzing what the business model of the Varun Beverages Limited is. So Varun Beverages is one of the world's largest PepsiCo franchisee. So it manufactures the bottles, distributes and sells PepsiCo beverages across India and several international markets. It accounts for more than 90% of PepsiCo beverage volume in India. So product portfolio, when you look at the product portfolio, so when you look at the carbonated drinks, it product it's Pepsi, Mountain Dew, Mirinda, 7 Up. And when it comes to energy drinks, it produces Sting, sports drink, and juices like Tropicano Slice and water Actifine. So the company also recently expanded into snacks and new beverages partnership, leveraging its distribution network. So most of its revenue is generating from manufacturing PepsiCo products, distribution and logistics, international operations, premium products and energy drinks. So when you look at the company's fundamentals, so the current market cap of the Varun Beverages Limited is around 1,71,922 crores. The current market price is around 508. So, when we look at the 5 years stock price, so on July 9, 2021, the company's stock was trading around 192 rupees. Now it's trading around almost 523, and the 52 high of the company is around 556 rupees, and the 52 low is around 381 rupees. So the stock P is around 54.1. So when we compare the stock P with the industry PEs, so the industry's median PE is around 88x, but the company is trading at a 54.110 PE, so which is quite below the industry PE. And when we look at the return on capital employed, so the company return on capital employed is around 19.7%, but where the industry's return on capital employed is around 11.13%, so which is more than the industry's PE. So Varun Beverages is one of the most uh, top companies in the beverages. So with the market capital of around 1,71,922 crores. So and when you look at the return on equity, it is almost around 16.2%, and the book value of the company is around 57.9%. So the company's dividend yield is around 0.29%, and the operating profit margin is around 4%, which we'll be discussing further. And the promoters holding is around 59.4%, and we can see that there is no pledged percentage of promoters in the company, and the peg ratio is around 2.26%, and the EPS of the company is around currently is around 9.41 per share. So when we look at the peer comparison, these are the peers that are operating in the beverages. So Varun Beverages, Wellington Nutrient, Orient Beverages, ANS Industries, Transglobes Food. So these are the five companies which are operating in the FMGC segment and beverages industry. So when we look at the profit and loss of the company, so we can see that the company is maintaining a calendar year, not the financial year. So the sales has been grown from 2,500 crores to 22,000 crores over a period of time. So So this represent approximately 20% of CAGR in over last 10 years. So this was mainly due to strong demand, capacity expansion, and geography expansion and market share gains. So when we look at the net profit, operating profit, it has been grown from 387 crores to 5,000 crores, which is quite good. But the operating profit margin is from 15% to 23%. But the industry's operating margin is around 12 percentage, which is quite good that the company is giving a operating profit margin is 23%. And when we look at the interest of the company, it's around 63%, and it has been gradually reduced over a period of time to 44 in the quarter. So when you look at the interest in the year, it was been 187, it has been gradually decreased to 177 over a period of time. And the net profit was in negative in the calendar year 2014. That is, it was around minus 20 crores. So it has been increased over a period of time to 3,062 crores. So which has almost given a 40% CAGR approximately in last 10 years. So when you look at the EPS, so it was around minus 0.9 per share for every share the company has had. So and it has been increased over a period of time to 8.98 per share. And when you look at the dividend payout, the company was not paid dividend for the shareholders during the 2014 to 2016 period because the company was facing a negative net profit and gradually increasing the net profit. But the company started paying the dividend to the shareholders over a period of time from calendar year 2017 to calendar year 2025. If you look at the component sale growth, so for 10 years it is almost around 20%. For 5 years it is almost at 27%. And for 3 years it is almost around 18%. And component profit growth for 10 years it was almost around 40%, and for 5 years it was almost around 50%. And for 3 years it was almost around 24%. So when you look at the stock price CAGR, for 5 years it was almost given a return of 39%, and in 3 years almost gave a 20% return, and in 1 year it was almost given a 15% return. So when we look at the return on equity, the company is giving a return on equity for past 10 years. It has given 21%, and for past 5 years it has given a 22%, and for past 3 years it has given 21%. So when you look at the balance sheet, before moving into balance sheet, so we can look at the operating profit increased from 387 to 5,000. This was mainly due to operating leverage is clearly visible. And margin, when you look at the margin, the higher margin was increased mainly due to better utilization, economic of scale, strong pricing power, growing premium profitability. So when you look at the EPS growth, which we already discussed, that it has been negative in the calendar year 2014, and it was increased to 8.98 per share. So consistent EPS growth is strong indicator of shareholders' wealth creation. So next, moving towards the balance sheet. So the company has maintained return on, equity capital in the calendar year 2014 around 134 crores. It has been increased to 600 crores over a period of time, and the company has maintained a massive reserves from 9 crores to 18,000 crores, and the company is also paying around 16 to 20% dividend for the shareholders. When you look at the borrowings, it has been maintained consistent in the borrowings from 2,000 crores in the calendar year 2014 to December 2014 around 2,600 to 2,800, which is very good. And when you look at the fixed asset, it has been increased over a period of time from 2,000 crores to 16,000 crores. And the debt to equity ratio for the borrowings, it would be around 0.13 crores. But when we look at the industry's debt to equity ratio, it is around 0.24, which is quite below the industry's debt to equity ratio. And when you look at the asset growth, it was almost had an expanded nearly 8 times. So we can see that the asset has been increased from 2,000 to 16,000. So it is almost around 8 times increase in the fixed asset, which means that the company has made a massive capex. So when you look at the fixed assets, which we already discussed. So this reflects continuous capacity expansion to support the future growth. Overall, the balance sheet looks strong and improving. So next, when you look at the cash flow, so when you look at the operating cash flow, it has been around 431 crores in the calendar year 2014, and it has been increased to 3,500 crores. And cash to operating profit, we can see that it has been around 80 to 100%. So this indicates that high earning quality, genuine cash generation, limited accounting manipulation. When we look at the ratios, the debtor days has been decreased over a period of time or maintained consistent in from 14 days to 21 days, which is very quite good for this FMCG industry. And when you look at the industry's days, it has been increased slightly from 77 days to 111 days. And debtor payables has also increased from 48 days to 53 days. There's no much increase in the debtor payables. It has been maintained consistent over a period of time. And cash conversion cycle also increased from 43% to 79 days. It's not quite good. So, and we have already discussed about the return on capital employed. So it has been given from 7% to 20% over the last 10 years. When you look at the shareholding pattern, the company's promoters have been decreased over a period of time from 73.66 to 59.43. So a red flag for the company. And when you look at the FIs, has been increased from 10% to 19%, which is good. Next, the key growth for the companies is that it has been alignment extended to till 2049. Like it has been partnership with PepsiCo and rural penetration and energy drinks. Sting is becoming a major growth engine and international expansion. So the company is expanding their business to Africa, South Africa, Morocco, Zimbabwe, and other markets are contributing increasingly to revenue growth. International business is growing faster than India. So key risks for the company is that like dependency on PepsiCo, like a significant portion of business is dependency on PepsiCo brands. So this is the major key risk, and weather dependency, like weak summer or excessive rainfall can impact the sales volume. So based on the weather, the company's sales can impact and high valuation. So as we discussed earlier, the company's fee is almost trading around 50 50x, but the median of the industry P is around 89, 88x. So the P is above 50 leaves like execution mistakes. Like next, the key risk is about health regulation. So like sugar taxes and health concerns could affect demand. Like most of the beverages uses sugar mainly. Next, So overall, so this is a premium business available at a premium valuation, and we look at the advantage. The company has delivered a good profit growth of 50 to 50.2% CAGR over last 5 years. So the company median sales growth is around 23.2%, and disadvantage is like the stock is trading at 8.95 times its book value, and which we already discussed, like the promoter holding has been decreased over the last 3 years. So this is the fundamental analysis of Varun Beverages Limited. We hope you enjoyed this video.